Is there anything you don't, other than like the short end? You were big on munis. You were big on you launched another fund too.
Yeah.
You like corporates. You like treasuries. Is there anything we don't like here?
Look, I think there's an opportunity cost for sitting in cash, and it is very attractive at 5% yield. But as Joanna said, and we would agree, we are seeing investors moving out on the duration and the maturity spectrum. One area that is interesting, though, is this insatiable demand for income. So we launched the Eaton Vance floating rate ETF almost 8 weeks ago. It's over 550 million.
EVLN is the symbol.
The
right?
ticker is EVLN. We've been managing floating rates for over 35 years.
Explain floating. These are bank loans, right?
These are bank loans.
What do you own here when you buy this?
You own bank loans, and this is a category in 1989 we helped pioneer in the mutual fund format.
When you say floating rate, they actually float, right? So it will move.
Consistent monthly income. And it does float. Right now, our objective is targeting a yield of approximately 9%. Now, even if rates go down, as Joanna highlighted, maybe they go down
what's the maturity of typical floating rate loans? 5 years? What are they?
Well, it depends on the actual issuance, Bob. But we would say even if rates go down, you're at 9%, they go down a half a point, 2/4 of a point cuts, you're still at 8.5% yield on the floating rate.
And you're talking about munis as well. I was just talking to him about this. You launched a new ETF last month for munis, TAXX, right?
Yeah, TAXX. We're really excited about this because when you think about municipal bond portfolios, we really want people to think beyond them, actually, and look for the relative value of after-tax income. And so this portfolio works a little differently, and it seeks the best opportunity between municipal bonds and non-municipal bonds in the portfolio. And for a taxable account, as Tony mentioned, like there's so much income in fixed income, you're really going to be not used to paying some tax bills on your fixed income investments, but 2023 you will. So here you should be mindful that you don't leave any money on the table with an after-tax yield or after-tax return by seeking all the opportunities in bond funds.
So what kind of after-tax return is TAXX going to have?
Well, right now the portfolios, the tax equivalent yield is close to 6%. It's about 5.88 as you look at it. And when you compare that to the big trade when interest rates were really low was going into short duration credit funds to help you like step out into cash and use those funds. And so while the yield looks similar on the paper, if you're not thinking about the tax equivalent yield, it's just the year to be thinking about taxes.
Well, 6%, I'm thinking again of my mother, my 95-year-old mother, who's delighted she's getting 4.5, whatever, in her one-year bank CDs. But there's a big difference between 4.5 and 6% yield at this point. So the point here seems to be, I mean, most investors will call me and say, Bob, you're making me crazy trying to figure out whether I should move into this splitting hairs. But 4% and 6% is actually a pretty big difference in returns overall. So they're all these bond funds are not the same. That's my point here, Tony, right?
Yeah, and one of the things that the ETF wrapper enables investors to do, both institutions who use these now and also financial advisors, is really get that precise exposure. They can do it through floating rate. They can do it through municipal. I think what's interesting is there's actively managed ETFs now, and there's also certainly passively managed. Some advisors are using passively managed fixed income ETFs to actively manage a portfolio, if you think about it.
Yeah, so they're tactically.
Yeah. So they're adjusting the exposure based on a building block approach or based on going straight to Eaton Vance.
Do you feel, I'm talking to the choir here, but do you think actively managed bond funds have a certain advantage over actively managed stock funds? I mean, we've debated this for years. The track record of active management equities has not been great long term. We know all the studies that indicate most of the time they don't actually outperform, even though they say in volatile times they will. Is there any evidence that you think that actively managed, and I know we're talking to a guy who runs the big organization here, but is there any evidence that it works any better, active management in bond trading?
I'm quite certain there's evidence on both sides. What I can tell you, though, is investors want choice, and they want to be able to allocate, and it's not uncommon to see a financial advisor who has passive exposures alongside active. Very few are one or the other. Many use both. So I think
Well, that is the smart answer, Joanna, right? I mean, we just give people choice, right? So he avoids the academic debate about this, but your thoughts on this?
Well, I think you summed it up really.
You're sort of neutral on all of this, right?
We're generally neutral. We see it as Tony does, I think, which is we don't have a philosophy on one is better than the other. What we think is really important is that clients and investors need help in these markets. They need help from their advisors, and their advisors need help from managers like Bond Blocks and Income Research and Management that's working on the tax fund. Because when you think about all this big opportunity set we all just described, and you're trying to make sense of it, an active manager in fixed income has insights, has a way to help you make your next decision, and that's what's important about, I think, active management and provider choice. And that's how I see it.
I'm just happy, and to pick up Tony's point about choice, but maybe not in the way he says it. I'm just happy that, you have 10-year yields north of 4% because it's so much more normal. What's not normal is to give
zero.
the government money for 10 years at 1%. That's just not normal. There's no, it's crazy. Who would do that? And yet people were forced to do that. Now savers have some way to actually have a real inflation-adjusted positive return, which is, it's about time, for crying out loud. What's been abnormal, and I know we had viewers complain, they're worried about it, 30-year mortgages going to 6 or 7%, but that's what's normal. What's not normal is 3% 30-year mortgages. People thought that this was historical. It's not. It never was. So what I'm happy about is things are getting a little more normal, the way they should. I don't know if I'm being preachy or not, but
no. But we hear that from the clients we work with. That as I said at the outset, bonds are back, and when you look at the allocation, equity, fixed, and other private vehicles. More and more, you can see active management happening in the fixed income sleeve. We haven't seen yields like this since before the credit crisis.
Yeah.
And I think investors, are pleased. Here's the real question, though, is that opportunity cost for cash. Yeah. You've seen the S&P 500 go up 25% since late October, right? So as investors think about how do I get off the sideline.
Higher yields have not crushed the stock market.
Yes.
They have not.
But whether they want to go back into the equity market or now they have choice in the fixed income market.
So
I think that's
I know you're not an academic, but we've had 40 years of declining yields, essentially, since Volcker broke the back of inflation in '82. It's been really 40 years of I guess you'd call it a bond bear market if you want to look at it that way. But that seems to be ending right now. And do you agree? And is that a good thing? It seems to be a good thing at these levels, at least. I don't want interest rates going through the roof and crushing the economy. But your thoughts?
Yeah, well, we'll see. I mean, the economy is very strong right now. We don't know what rates are going to do this year. If they get cut 1, maybe 3 more times, remains to be seen. But right now, we know our investors are expressing a view into fixed income ETFs more and more.
The other issues, of course, and I sound like an academic here. I'm talking to Wall Street people about academics, and they hate doing this, by the way. But inflation, global inflation, how it's changing. If you look at what's been going on with the global supply chain, with globalization or deglobalization, when you're talking about putting a new fab factory in New Mexico, billions of dollars. That's going to reduce the efficiency of the supply chains, and there's a reason inflation's a little higher and should be higher, and interest rates should be
I think, too, there's also the differentiation in all the markets and in inflation and different economies. Everything's performing differently, and I think that's another tenet of Bond Blocks coming to market is that you can start to see the differentiation of these opportunities in fixed income, which you couldn't see with zero interest rates before. They didn't jump off the page as they do today, and there's a lot of opportunity that needs to be. We have to remind people of the fundamentals of bonds again. How total return works, that it's income and price appreciation, and what happens when interest rates impact those things. And so I think that's another thing we're finding is this massive re-engagement with this more normal bond space and rate space that we all lived through and remember.
So what does this mean for the ETF space? More mutual fund conversions from bond funds continuing? I mean, this has slowly been going on.
We're just over a year into this, Bob. We've launched 14 ETFs. We were just over $1.7 billion at the end of the first quarter. 2 of the 14 are actually conversions. We'll continue to evaluate our existing mutual fund lineup for conversions, but we're also committed to launching organic new. I do think a number of organizations have looked at converting, but we'll evaluate one by one.
Yeah, I think the important thing is investors are finally getting yield and they're responding to that. So more product is fine with me. Active is fine with me, providing the fees still remain low. I'm a Jack Bogle guy, remember? Jack like active as long as the fees stayed low. So we're keeping an eye on that for everybody. Thank you both. Very informative.